My name is Dana Golden. Thank you for sticking with me to the end of this take on environmental macroeconomics. I'm going to finish up this section by looking into and giving an overview of environmental finance with a particular look at ESG investing and how it integrates non-financial factors into investment decisions to identify sustainable and ethical investment opportunities. This has been a big thing in the past few years. There's now a very big backlash against it. So key components: climate change, resource management, pollution, renewable energy. There's a focus on that in the environmental, and then in social, there's this focus on human rights, labor practices, and diversity, and governance is focused on corporate ethics, board diversity, executive pay, and transparency. The goal is partially to enhance risk-adjusted returns long-term, based on the idea that these are good ideas in general, but also to insert an ability for people to choose what they want to invest in and what they consider ethical. I should note that there is no definition from the Securities and Exchange Commission on ESG investing. The Securities and Exchange Commission won't tell you investing in fossil fuels is not ESG, it's not good for the environment. They will say, if you say we try to invest in things that are not fossil fuels, they will go after you. So right now, there's no rules about whether or not you're actually doing ESG. There's rules about whether or not you're following your own definition of ESG. So the rationale for this being good and having good returns is the idea that companies with strong ESG practices are less exposed to environmental, social, and governance risk. There's a strong argument that in the very long term, these are the only risks that matter. Obviously, governance is very important from a company. I don't think anyone has a problem with the G here. I don't think anyone's like, I actually think we should go out of our way to make corporate governance bad. Maybe Elon Musk. Maybe Elon Musk is the one who's like, actually, I think the best companies have terrible support for shareholders and just support the CEO. But I think everyone else kind of agrees that good investment returns come from good governance. I think when people have the problem, it's usually with the E and the S. So the reason why this mitigates risk is it potentially reduces likelihood for regulatory penalties, reputational damage, and operational disruptions. Obviously, sustainable resource management lowers costs, improves long-term profitability. There's a weird argument that you actually, with ESG investing, even if it's not, there's a weird argument that even if it's not good for one firm in general, it's good for the market as a whole, and therefore it should be done. And this is based on the idea that firms should serve their owners, and actually right now most of the owners are ETFs, and so most people own a basket of goods, so actually companies should be doing not what's best for themselves, but what's best for the broader economy. You're seeing a little bit of that in the backlash against environmental, social governance investment, in people saying, actually, the fact that you're doing this means that you're colluding in some way. You're not seeing a lot of that in terms of how companies actually act. I don't believe any company is actually like, let's take the day off because it's better for our entire industry if none of us compete. And then, of course, the market just prefers firms that are doing good for the world. And then studies show, a few years ago, it looked like ESG investing was doing really well, but recently studies show very mixed correlations between ESG scores and financial performance. Recently, they've done pretty poorly. It's interesting, renewable energy stocks and green technology actually did really well under Donald Trump the first time, under Trump 45. We'll see how it does in Trump 47. Did very poorly under Biden, surprisingly. And the reason was high interest rates. We'll get into really heavily into how interest rates impact renewable investments in the second half of the course. Obviously, strong governance practices are linked to better financial outcomes. I don't think anyone is surprised that if you stop people from stealing from your company and you provide good mechanisms to run the company does well. I think anyone who says the G is bad here is not thinking clearly. So recent developments in ESG ETFs. BlackRock in 2021 launched the U.S. Carbon Transition Readiness ETFs and amassed over $1 billion on its first day, with the largest ETF launch in history. In 2023, it launched 5 climate transition ETFs in Europe and targeted countries that are leading the shift. It's since evolved a few of them. It's continuing to move away from this. You see the same thing at State Street. 2022 launched 3 Spider ETFs that had an enhanced ESG portfolio. And then 2023, it closed 3 of them because investors were not interested. ESG ETFs were very big at one point. They've since kind of had a falling out. Part of this falling out has been from regulatory scrutiny and enforcement. The SEC has intensified actions against greenwashing, penalizing firms for misleading ESG claims, including Goldman Sachs Asset Management was fined $4 million for failing to adhere to ESG investment policies. And then Deutsche Bank agreed to pay $25 million over misstatements and anti-money laundering violations. And then Wisdom Tree paid $4 million settlement for misleadingly marketing funds. There was a lot of growth in 2021, but recently there's been a lot of movement away. Part of it is a legitimate concern about greenwashing, and a part of it is a cultural backlash about just this kind of investment. A lot of conservatives don't believe that ESG makes any sense, and some very important critiques. Obviously, the greenwashing companies often say they're very ESG, and then they aren't. And often the companies that are investing in those companies say they do a lot of good diligence, but they don't. And there's not really standard definitions across the board as to how these are applied. And the SEC kind of just lets you go with it. So there are ESG investment funds that say pretty deliberately, we invest in fossil fuels because we consider fossil fuel energy as a part of the transition plan, particularly natural gas is there, and the SEC will only stop that if you say we don't invest in natural gas. A lot of people say ESG investments sacrifice financial concerns for ethical considerations. Yeah, there used to be a very good argument that ESG outperformed. That's kind of gone away recently. I think actually we need a much longer time horizon to make these calls. And there's a big question as to whether ESG investing really drives real world change, and over the fact that ESG investors aren't able to own companies and therefore can't control carbon intensive companies. Some carbon intensive companies may get worse because now their cost of capital has gone up, and a lot of the ESG money and a lot of the green money goes to companies like, I guess Salesforce is an example. Not anymore. Tech used to be very ESG. Now it's not because it used a lot of energy, but a lot of it used to go to tech where of course they're pretty green. They don't make things. They are building software. But if you were a cement company that was trying to do very green things and were trying to make cement process better, you were not rewarded for that. They just pushed up your cost of capital. So there was a feeling that that ESG was not really taking into account that the real change was by making companies in dirty sectors clean, not rewarding companies in traditionally clean sectors. And then some critics argue that ESG investing creates artificial demand for ESG assets, and there's a potential for bubbles in green sectors. This is basically popped by now. You've seen a lot of loss of value in these recently. If you want, please check out Industry. The most recent season of the television show from the UK, Industry, does a really great take on a bubble in ESG investing. Does ESG outperform? Yeah, it's very complicated. It's not very clear. Obviously, the governance is very important. Whether or not environmental and social outperform, my answer is yes. I think in the short term, no, but in the long term, environmental and social factors matter a lot, and so it does outperform in the long term. Thank you so much, and I hope you have a great day. I'll see you next time for our foray into data and environmental economics.